PE multiples, that's not the metric you use to value stocks.
Exactly.
Like that you don't even look at PEs now to pick stocks.
Yeah,
Why not?
it's really interesting because when we were at Franklin Templeton, we Graham and Dodd, Warren Buffett, they're the mentors, and John Templeton, my mentor, always looked at PE, price to book, not exclusively, but that was sort of the measure. So if a company had a low PE, they say, hey, that's a bargain. No more. From my point of view, that's not, you don't want to be looking at PEs. Because PEs are a backward-looking measure, because you're looking at the earnings currently and backward. Okay, you're doing projections, but how do you project the earnings of a company? So what we're doing now is saying, okay, forget about PE. Let's look at return on capital, return on equity, because that measure is very difficult to be changed from one year to the next, because the nature of a business is very much reflected in the return on capital. So if you have for example, our criteria is that a return on capital of at least 20%, more often than not, you have a company with that characteristic, they have no debt or very little debt. So the next characteristic we look at is debt equity of less than 50%. Very easy if you have a ROE of 20% or more. And then earnings growth is there as well. So we look for at least 10% earnings growth. So those three characteristics, and of course, we need liquidity. We're running open-ended funds, so we need at least $1 million turnover per day. So we've found that those really worked well for us, those criteria.
That's for people that live in Hong Kong, just using that criteria is almost when you tell the property agent, I want a big apartment with a large terrace under this price with 5 bedrooms. Well, the reason I bring that up is with that criteria, aren't you almost shrinking your possibilities? Like how large is that pool of stocks that meets all of those simultaneously?
Very difficult to find. Very difficult.